Well, now it's time to check your money with America's money maven, Vicki Brackens. Vicki Brackens is president of Brackens Financial Solutions Network, LLC, and a registered representative of LPL Financial, member SIPC, and a great sponsor of Inspiration for the Nation. Good morning to you, Vicki.
Well, good morning, George, and good morning to our audience this morning. You know what, George?
What's up, Vicki?
It's starting to feel like summer again, around here. Okay, finally. So today I want to make sure that we go back because you, in fact, brought up a couple of topics a couple of weeks ago that I said I'm going to put the lid on that and come back to it because you wanted to investigate, number one, junk bonds. Remember that?
Oh, okay. I did ask you about that.
Okay, and I said, nope, we can't do that right now. And also floating a bond as far as what happens when municipalities and governments issue bonds. Mm-hmm. But before I have a question for you, George, so listen real carefully here. Before I go into those topics, I want to ask you this question. As an investor or as a lender, deep down in your stomach, what is the one thing you worry about when you either invest money or lend money to someone? Way down. Think about what's the first.
Am I going to get my money back?
Am I going to get my money back? Absolutely. And that is probably one of the biggest risks that everybody has when they talk about investing or lending money. But what's the second thing you worry about, George? Am I going to get my money back when?
Right.
I need it.
When I need it.
So when you add those two things together, that gives us the foundation of the discussion that we're having today.
Let me reframe that. So
sure.
It would be, am I going to get the return on my money that I expected? Right? Is that another way of looking at it?
No, that is not.
It is
not.
You said that. Okay. Because you get my money back. I'm thinking, is that realistic?
Yeah, because everybody wants to, and we have a saying, it's the return of my money, not just the return on my money. But when you really talk about the psychology of investing or the psychology of lending, and if you recall, we said that equity is more of an investing principle, whereas fixed income is an investing principle, but it's more about the lending of versus receiving share ownership. So what everybody really deep down in their stomach really worries about is, and this has to do with, it doesn't matter what level of investor you are, am I going to get my money back?
Right.
In fact, I'm going to give a little plug here. When you talk about watching Shark Tank, what does Mr. Wonderful always say? When am I going to get my money back?
How?
How? Exactly.
When and how?
Am I going to get my money back?
Right.
Okay. So I'm bringing this point up because it's the getting the money back that's really a foundation piece on how bonds, and you ask about junk bonds, how bonds are classified. Bonds are classified based on credit rating. Just like you have a credit rating, bonds have a credit rating. And what that's really being measured is the likelihood of default. Will the lender, which is actually the investor, have any risk around getting their money back? What's the likelihood of default? And that rating is very similar to the rating that you have on an individual basis, where our rating is based on a number, somewhere between 300 and 850. With bonds, there are rating services, and that rating really runs between AAA down to C and D. If you drop into double B or less, and what's being measured is their solvency, their cash flow, their current debt structure, all of those things. If you drop down to double B or less, you are now in a category that's called junk.
Right.
Or we changed the name, by the way, some years ago from junk
to high risk
to high yield.
High yield, right? Because those same bonds with that high risk also have high yield.
There you go. Why do they have high yield?
That's a good question, Vicki.
For the same reason, if your credit rating is 600 or below, you are considered to be a high risk.
Right.
In order to entice investors, in order to entice the bank, you have to agree to pay more interest. They have to agree to pay more interest. Higher yield. Okay, so it all works together, and I wanted to make sure that we talked about this because when you really look at investors in bonds, whether they be junk bonds or government bonds, you are an investor in bonds. Did you know that?
Tell me why.
Because you are a citizen of this country.
That is correct.
And as a citizen of this country, you pay what?
Taxes.
And when those taxes are used for infrastructure or anything else, or we need to do so, the government issues bonds.
Yes, they do.
And who's responsible for repaying it?
The government.
And who's the government?
Me.
You.
Thank you.
Your money from your tax revenue
Yes.
is being used to, and the term is service.
Right.
To service the debt, to pay those interest payments to the lender. And who's the lender? Could be other governments.
Could be other governments.
Could be who else?
Who else could it be?
Pension funds.
Right.
Well, if you're in New York State and the pension fund is actually investing in bonds, whose money is that?
Mine.
It's yours.
Yes.
It's your money from your work and labor related to your pension fund in the future. So, you have insurance companies and governments and individual investors who have excess cash. That money is moved out to the market as far as the bond market is concerned, and that is used to pay to service the debt. And if you're looking at bonds rated less than BB or below, they're paying a higher yield. So why would I want to choose a riskier investment? Because the junk bond or high yield market is a pretty big market. Why do you think that happens?
I don't know. Tell me why.
Okay. It happens because the potential for more revenue coming back outweighs the potential for default in the eyes of the credit rating service.
Right.
But you have to realize that when you are taking on high yield debt, you are taking on more risk. Well, George, I think at this point in time, that was a mouthful.
That's a mouthful.
Okay, so
that was a buffet, all you can eat.
So I'm going to say at this point in time, our plate is full. But if you have any additional questions, feel free to give us a call at area code 315-930-4499 or info@brackensfsn.com.
And we should also do what on YouTube?
Oh, thank you. And you should pick us up on YouTube because all of the segments are there at Brackens Financial Solutions Network's channel on YouTube. Please subscribe.
All right. Vicki Brackens. Vicki Brackens is president of Brackens Financial Solutions Network, LLC, and a registered representative of LPL Financial, member SIPC.